All right, so this video, we're going to talk about step five. After we've made the adjusting entries here in step four, we have to then first update our T accounts for the adjustments we made. So, for example, we have this entry to our depreciation expense and our accumulated depreciation. If you go back to the file, the Excel file of the unadjusted balances of these accounts, you'll see that we do not have a depreciation expense account yet drawn up because there was no depreciation expense at the beginning of the year. And we went up into the unadjusted balance with no depreciation expense still recorded because depreciation expense is just one of those accounts that we do not adjust, that we don't typically find until adjusting entries in estimate. So at the unadjusted trial balance date, this was still zero. That's why we didn't have an account for it. But now we made an adjusting entry debiting it for 5,026, 5,626, my apologies. So that enters in here as a debit, 5,626, and creates the adjusted balance, the adjusted, not unadjusted, adjusted trial balance that we would find after we made that entry. Now, the accumulated depreciation account is a bit different. That one is on our ledger with an unadjusted balance. So let's take a look at, or if you have it out, you can take a look at it. I'm looking at mine on my computer, and it started at a $70,000 balance. We sold some of the equipment in the middle of the month, and that got me to, we had $5,000 of accumulated depreciation that we uh, canceled out because we sold the equipment that 5,000 was associated with. And that left us with $65,000 of accumulated depreciation. And this was my unadjusted balance, right? But then I have my adjusting entry that I made here, the very first one, crediting it for the same amount of depreciation expense, 5,626. And altogether, then we have $70,626. And this is my adjusted trial balance for accumulated depreciation. All right. We could do this, right? And, if we didn't have the answers provided to you by myself, we would have to do this for every T account. Now, I uploaded another Excel spreadsheet that has both the unadjusted and the adjusted balances. And I'm going to go ahead and share that document with you now on my computer. Here we go. So this is the second Excel file that I uploaded in the folder. And right here, of course, on the first tab is our unadjusted balances, the ones that were already uploaded before. And so nothing new, no new news here, but we go over to the adjusted balances and I started doing a little bit more color coding so that we can specifically tell the difference between the adjusted balances and the post-closing trial balances. I'm sorry, the unadjusted balances, the adjusted balances, and the post-closing balances. There's no post-closing balances yet. We're not to that step, but there are the unadjusted and the adjusted balances highlighted in these colors. Notice, of course, there's no adjustments to cash because adjusting entries never include cash. Adjusting entries are solely income effects and the asset liability account that they impact, but never is this going to be cash. AR typically does not have an adjusted balance either. We adjust something else associated with accounts receivable, and that account is its contra account, this allowance for credit losses. Notice we had that unadjusted balance of 7,650, but when I made the entry to record bad debt expense. And I did that on a separate sheet of paper for you guys, where we had the amount of 7,650 as an unadjusted amount, and then we credited the allowance for credit losses for $8,600 so that we could arrive at our desired ending balance, which was our adjusted balance for that account, $950. So you can look through and see this sort of color coding going on. Yes, some of the accounts will not be adjusted. Sometimes those accounts, like equipment, have a contra asset account that gets adjusted instead of the primary parent account itself. And sometimes we do that adjustment straight to the parent account. There is no contra account. For example, the patent, we credited it by 417, and that resulted in a balance of 74,583. Where's the amortization, you ask? Well, it's down here, right? My amortization expense began at zero, and its unadjusted balance was zero as well. It then was adjusted for $417 to record that amortization. The credit was up here to the patent, and it created an adjusted balance of 417. Notice that none of our expense accounts, our revenue accounts, our gains, our losses, none of them have opening balances. And that's because we close all of these accounts regularly at the end of the accounting cycle. Any income statement account we close at the end of the accounting cycle. So right now these have balances, but once we get to step 7, we're going to take away all these balances, reset them to 0 for the next month. This also is in line with how I format the project, the practice set that you're about to embark on, where every ledger account has a highlighted cell, or one or two cells that will show you where that ledger should end. It'll show you one color for the unadjusted balances, a green color for the adjusted balances, and then a slightly lighter peach color, not yellow. I just used yellow here, for the post-closing balances. So this is what the action would be in all of our accounts. And again, this is downloadable. You can print it. It's hard to see if you actually print it because you have to shrink it to fit on a page. But hopefully this gives you a sense of how we update these accounts without me stepping through and creating a T account for every single account. If you have any issues with this, of course, please let me know. If you don't understand exactly what's going on or what I've done here, let me know. Again, I only have a horizontal line when I am establishing a new trial balance. So I have an opening balance, here's 0. This was a journal entry from step 1 journal entry, step 1 journal entry to unadjusted balance, adjusting entry, adjusted balance, right? Now, all we have to do is take these balances and shuttle them over into a adjusted trial balance. So I'm going to return to the camera view of the adjusted trial balance. Now, notice that I provided some lines in here, or some spaces between the accounts, and those are necessary in order to accommodate the new accounts that we'll be bringing in that were not on the unadjusted trial balance. So we take, for example, this cash account at 122,750. That was its unadjusted balance. It didn't change. So it's still that at the adjusted balance. Same story. The unadjusted balance for our accounts receivable just flows forward because there was no adjustment to that account. But now our allowance for credit losses is no longer at a debit balance, but at a $950 credit balance. This is my first gap. And what's going to go there? Well, we're going to have another receivable. One of the things that we had for this company was a pre-tax loss. And so we do not get taxed on losses. In fact, we get refunds for losses instead of being taxed some of our profit. So in this case, the company stands to get a refund of $4,729. That's my tax refund receivable. which was an account that was not on our unadjusted balance. So we have to make room for it now. And I make room for it specifically here because there is an ordering to our trial balances. Remember, we want to order them in terms of assets to liabilities to equity accounts to income statement accounts, right? So that's one of the assets we've written through or written in here as a part of the adjusting process. We have $8,750 of our inventory, and I don't have to keep reading these, but these are coming directly from the balances we see in the Excel document that you'll have uploaded there. Our land, the equipment, the accumulated depreciation that we worked on the prior page, the patent, payable, our wages, deferred revenue was adjusted downward, but we still have 23,000. Now, again, I left a line here because one of the current liabilities that we did not have on our unadjusted balance was interest payable, right? We accrued interest expense and recognized the fact that we owe some interest in the future. The liability shows that I owed some interest, and the expense, the interest expense, shows that that is an expense that I should have matched to January's earnings. Our bonds have 300,000 balance. Common stocks at 11. Additional paid in capital is 269. Retained earnings 312, 650. Sales revenue 83,000. Cost of goods sold 39,500. Our wage expense is going to be an addition of what the unadjusted balance was plus what we adjusted it for. We adjusted it for 24 and it was at a $25,000 balance already, so it's at 49 now. And now we have a bunch of expenses that we need to write in because they weren't there. These all came out of the adjustment process. Amortization was one. For 417. Remember that credit went to the patent account. That's why the patent is now at 74,583 because we reduced it by 417. Depreciation expense was 5,626. Interest expense was 1,500, the same as the interest payable. Bad debt expense is 8,600. Insurance expense is 1,000. Rent expense is 3,000. And finally, tax expense. Now, tax expense, if we had positive pre-tax income, would have been a debit balance. But remember, we had negative pre-tax income. And so since the pre-tax income was negative rather than positive, then I'm going to have a credit in this account for 4,729. And then finally, our gain on sale moves forward $2,000. Now comes the moment that we have to check to be sure we've done things hopefully right. Remember that the equality of debits and credits here does not mean that we 100% have it correct, but it gives us some assurance that at least that we're not wrong. Okay. Not a guarantee we're right, but at least we know that we're not wrong if these two numbers equal. So I'm going to go ahead and add those up. And when you add all those numbers up, you should come to a total of 1,114,455. 1,114,455. Okay, so debits equal credits here. Again, this doesn't guarantee our accuracy, but it gives me at least no cause to believe I've done this process wrong. Okay, so now that we've finished the adjusted trial balance, we move into step 6. Step 6 is going to be where we take this information and begin making the financial statements. And in particular, we're going to start with the income statement because once we have our adjusted trial balance, we have all of our income statement accounts present at the appropriate account balances, right? And ready to go. So these will all go to the income statement. Right? Once we calculate that net income, we'll take it to retained earnings, figure out what retained earnings should be, and then we can make a balance sheet, right? But that will be in the next video. And I will also talk about some concepts that relate to each of the financial statements.